Joining me now is Rick Bensinger, president of In the Know Trader. Thank you so much for joining us, Rick. It's been some time. How are things on Wall Street?
It certainly has. And in fact, I got to think of the last time you and I saw each other on video. It's been a while.
It's been a while. It's been a while. Look, let's get straight to it because everyone has been waiting for this moment to meet you. I've highlighted this to our clients, and those of you that don't know Rick, he is a legend on Wall Street, ex Morgan Stanley, ex Wells Fargo. Give us a snapshot of your illustrious career, Rick.
I traded in the pits, the commodity pits, for 12 years right out of college. And ultimately, mostly stock index futures. I traded gold, silver, and cocoa. And ultimately, I said enough of yelling and screaming all day. Time to get a, quote, real job. And I was very fortunate I was able to get to Morgan Stanley. I spent a couple years there, and then Bloomberg actually poached me to be head of commodities technical analysis and all the futures applications. So I went there and I actually built their entire charting system. Went back to Morgan Stanley 3 years later, and within 1 year was made chief market strategist of the firm. Stayed there many years and then some other places on the street. And for the last 10 years or so, I've been on my own consulting to the street. I have both an institutional product as well as In the Know Trader, which is for retail and financial advisors. And the one other piece of the puzzle I'll tell you about myself is that NYU had come to me in 2008 to develop their entire behavioral finance program, which I did for them, as well as teach the core course in it. And I have to say that probably between commodities trading and then teaching behavioral finance, those two elements of my entire career probably give me the real edge that I have over most people. It's understanding the markets from a behavioral psychology point of view, what makes people make decisions when they do. And having traded in the pit, there is no better education you can get about markets.
That's it. That's right. I miss the pits too, and you can actually smell the fear. You don't quite get that on a screen, right?
You do not.
Were you one of those with the super high shoes in the pit so that you could, you could be taller
No,
than all the other
I
traders?
clock in at 5'11", so I at least had some height. And I always stood on the second step when I was a local, meaning just one step below the brokers. So I had access to brokers right over my shoulders. But boy, I miss those days too.
Me too, me too. And they still have that in the SIBO in Chicago, where I was a couple of months back. Let's talk
Yeah.
about how you deliver these significantly higher gains through your experience in the pits and also through behavioral trading and teaching that, and also having skin in the game for so long via commodities. Let's talk about Intel because you've got some really interesting markings on this chart.
Yeah. So let me pull up Intel, make sure there we go. I am on the correct one. And now I've lost you. Hold on a sec. Where is Ange? There we go. Okay. So why I like Intel is that it's terribly underowned. You'll see on the right-hand side of this chart towards the bottom, there's a number 13. And as you and I spend time together, I will start teaching the viewers here on how to use this particular model. It is one of the most institutionally followed models on the street, developed by a gentleman named Tom DeMark. And it is a terrific tool to help understand where a trend has exhausted itself. And I personally own some Intel too early at 32, but I bought more at 18 because of that signal. And now I'm doing very well on it. You can see here, it's just broken out above kind of this mid-40s level, closed
Yeah, that
yesterday
area
at
of interest
48 and
there.
change. And I want to be a buyer in a pullback here. As well, you could buy some here. It's a little extended, but You can see those green rectangles on top. I think we're probably going in the upper 50s. It could be as little as 2 months. If the bull market kind of comes back, this thing could fly and get up to this 57, 58-ish level. And that's why I kind of want to be long the name as well as buy on pullbacks.
I like also highlighting the kickers, or what I call the red flags. So, what are your kickers for this? When is it when time to reevaluate because there's a change of structure?
If this spent a couple of Fridays under 32, I would say it becomes a little dicier. And then you can see we're kind of in the neighborhoods of what a prior high was. We've taken that out this week, and as long as we go out solid this week, I kind of think that this is set up to go higher because there are so many non-believers still.
Fantastic. Let's move on to the next one because I know you're a very busy man. Canada Goose. I have a story surrounding Canada Goose. I see you're also looking there's a formation there of a triangle, a swing area.
So, yeah, to me, if this thing gets above 15 and a half or so, you would take out all these prior highs over the last couple of years. You have, let's call it an inverted handle and cup, almost maybe inverted head and shoulders type thing. And to me, this is the area it broke down from. We've gone there a few times in 2025. And I think bulls are back in control if you get above 15 and a half. So right now we're holding the uptrend line. It's played with it a couple times in the last month. It's still holding. You have to be a little more aggressive to buy it here and hope that the trend line holds. But if it gets above 15 and a half, I think, it kind of says all the selling in the last couple of years are people who are wrong. I don't know what the short base is on this, but just conventional technical analysis would tell you it's likely heading higher. And you can see just a couple of weeks before the lowest low was made in the first quarter of 2025, you had again that 13 signal suggesting downside exhaustion of trend. It played with the risk level associated to that signal, held it, and it's moved up nicely since. So this is certainly a name on my watch list.
I'm definitely a safer but later. You know me, Rick. So I would wait for that break above there. Up next, you've got a long XLE but short XLK. Is that right?
That's correct. So this is clearly a complete opposite trade to what we saw in 2025. Energy was a dog. It's been underperforming the S&P for 2.5, 3 years. It's getting a little bounce. Today it's down because President Trump said, or has pulled back a little bit on potentially going into Iran. But that's fine. I'd like to buy. To me, the orange boxes, and again, I'll be consistent with this. Orange boxes are typically support levels on my charts. Bright green ones are resistance levels. And in this case, same thing. We've just taken out the high from November. I'd be a buyer of a pullback of this pair trade, so you can wait for it to come in a bit. But I think over time we're going to test that ratio, and the numbers off on the right-hand side are the price of the XLE divided by the price of XLK, which is technology. So this is really a counter-trend thing saying essentially a lot of Mag 7 is played out for now. I don't think it's the best place to be in the market. In fact, I told clients, you probably want to look at the top 25 names in the S&P on a cap-weighted basis, minus the Mag 7 names, for better performance than Mag 7 in 2026. So Tech, XLK, XLC, XLY are the three ETFs that those Mag 7 names are in. This is XLK, which is predominantly Apple, Microsoft, and what's the third one? Can't remember offhand. Buy a pullback here, play for the double, for the double bottom that's increasing. And ultimately, this has a chance to move up also to, that green target area, which is both an old high as well as a measured target off of the low.
Now, here's the thing. I've been watching loads and loads of aerial shots, flight radar and maps as well. What happens to this pair trade, Rick, if your president, Trump decides to then surprise everyone in a week or two, right? He's doing similar things that he did when we had that last strike, and there's been a lot of mood music now, going back on the strike that he said might happen. But what if it does happen? Is that a kicker for this trade?
Yeah, it probably would be. I think oil would go higher. It's also, it's got a triple bottom at 55-ish. It's moved up last week, not last week. Yesterday's close was the best in 6 or 7 weeks. And the thing with Trump is, as we're all learning, he'll say something on a Monday, he
Yeah,
changes it on a Wednesday, and then Friday does what he said he was going to do on Monday anyway.
yeah.
So just looking at this formation, it makes me want to be a buyer on a pullback into this kind of orange level and play for a move up. Now, this isn't a huge move, but in percentage terms, if you're trading at about 0.33 now and we're targeting 0.37, multiply that to, you're talking over a 10% gain on a pair trade. And so it's a hedged bet in general because you're long something and you're short something else against it. These are macro sectors to the S&P.
Very
So,
quickly, Rick, I know you've got 2 minutes to go. I want you to catch
yep.
that train. So let's quickly move on to cocoa, if we may.
Yeah. So the reason I want to show you cocoa is more than anything else is why institutions care about this particular model. So here is a monthly chart of cocoa futures traded in the U.S. on the Coffee Sugar Cocoa Exchange. When those 13s come in above price bars, those are potential. Those are signals for potential upside exhaustion. So you look in 2014 and late 2015; those are 13, what we'd say 13 sales, upside exhaustion of trend. Then look at the low in 2021. That's downside exhaustion. And then look at the craziness over the last few years of the move in cocoa and where that 13 is for a sale. This is a monthly time frame. People look at this on 5-minute charts trading S&P futures. This model is something that I will help teach over time. It is not a simple model at all, but I will introduce this to you and tell you that institutional traders and portfolio managers do not care about RSI and MACD and a little bit about moving averages, but this model is used by the continuously most successful hedge funds and mutual funds in the world. And I got introduced to this model in 1996 and have taught more people on the institutional side how to use this model than any person there is for the last 30 years. So it's also because I've taught so many people how to use this that it has spread across Wall Street, and the public generally has no idea about this.
Yeah, I can attest to how cool this model is as well, because it is one of the things you're tested on the STA, which is the Society of Technical Analysts here. Just one final question before I let you go. Is there a reason why you're using the monthly?
No, here it would just happen to be to show, even in a long-term perspective, that this model can be extremely helpful. Is every signal correct? Of course not. But there's no other model I know of, Ange, that more closely gets you to play the turn of a move than this. If you wait for MACD to cross, if you wait for a 50-day moving average to cross above a 200-day, you're way off the low or way beneath the high. This is the only model I know that in real time actually gets you a chance to buy the low or sell the high of a move.
Fantastic. Thank you so much. Such a pleasure. Not every day do I get to pick Rick's brains in front of all our very, very valued clients. I hope you found that as useful as I did. Rick, thank you so much. And you should go and catch that train right now. Whatever you're doing, may the odds be in your favor.